In January 2019, a group of private investors settled on a number: $47 billion. The company attached to it didn't build software or hardware or anything you could ship. It signed long leases on office buildings, furnished them well, and rented the desks by the month. 7 months later, it filed one document with securities regulators, and the story the market had been telling itself came apart in public, line by line. To understand how a landlord ended up with a technology valuation, start with the man who sold it. Adam Neumann was born in Israel and arrived in New York in his 20s, chasing business ideas that never quite caught. What caught was a Brooklyn co-working venture called Green Desk, built with an architect named Miguel McKelvey. Cheap space, shared, rented in small pieces to people who couldn't justify a lease of their own. It was a modest operation with a modest premise. It also worked, and it taught both men something the commercial property industry had mostly ignored. The demand for office space had gotten smaller, faster, and far less patient than the leases that supplied it. In 2010, the two of them opened something more ambitious in Soho. They called it WeWork. Good light, glass walls, coffee, communal tables, events after hours. The pitch was never square footage. It was space as a service, flexible, designed, and populated by people you might actually want to sit near. Members bought a desk. What they were told they were buying was belonging. The timing was close to perfect. A generation of startups needed room to grow and no interest whatsoever in 15-year leases. Freelancers were multiplying. Larger companies were beginning to want satellite teams without construction budgets. WeWork filled the gap, and it filled it fast. And investors did not see a property manager. They saw density. They saw a network. Thousands of small companies inside a single system, and the suggestion that the system would compound, that every new location made the existing ones more valuable. That framing mattered more than anything on the balance sheet because it decided the math everyone used. Real estate trades at real estate multiples. Technology platforms do not. WeWork was valued as the second thing while operating, in every practical sense, as the first. Capital followed. By 2014, investors valued the company at roughly $5 billion. New floors opened in new cities on a schedule that would have frightened a traditional operator. Growth was the product. Then came SoftBank. Masayoshi Son and the Vision Fund became the defining backer of the company. Around August 2017, an investment path of roughly $4.4 billion was announced, and reporting on the individual tranches has varied ever since. Across the full relationship, SoftBank's total commitment is often described as more than $10 billion. By 2017, WeWork was operating around 200 locations at a valuation near $20 billion. In January 2019, the private mark reached $47 billion. Lifetime financing raised across the company's history, on the order of $12.8 billion or more. Neumann led like a founder who believed the mission, community, purpose, elevating the world's consciousness. That was the register, delivered with real conviction to employees, members, and investors alike. Company gatherings ran closer to festivals than offsites. Reporting from the period describes a culture organized around the founder's energy and a workforce that largely bought in. Charisma was raising capital as efficiently as any spreadsheet. But there was a problem underneath the enthusiasm. The expansion mandate meant signing long-term leases at speed in expensive markets ahead of the demand that was supposed to fill them. Costs ran hard. Reported spending on build-outs, events, and executive lifestyle drew heavy scrutiny as the company approached the public markets. None of it was fatal on its own. What made it dangerous was the arithmetic it was sitting on top of. There were structural questions, too. Contemporary reporting described related party arrangements between Neumann and the company, including real estate in which he held stakes that WeWork leased. Then there was the trademark. Ahead of the offering, the company restructured under the name the We Company, and the attempted economics around who owned the We brand and what the company would pay for it became one of the loudest flashpoints of the entire episode. The IPO was supposed to be the coronation. On August 14, 2019, WeWork filed its Form S-1. For the first time, anyone could read the numbers. They were not what the private markets had been pricing. a net loss of approximately $1.9 billion for 2018. Billions in future lease obligations stretching decades forward. No clear path to profitability. Supervoting shares concentrating control with the founder. The related party web, now sitting inside a public document. And a set of community-adjusted performance metrics that professional investors treated less as innovation than as a warning about everything else in the filing. This was the moment the private story met a public document. It did not survive the meeting. Fund managers who had never questioned the valuation started asking what, exactly, they would own. Within weeks, the marketed figure fell from roughly $47 billion toward under 10. Bankers cut the range, then cut it again. The offering was withdrawn, not delayed, pulled. In late 2019, Adam Neumann stepped down as chief executive under a SoftBank-led rescue that also shifted control of the company. His exit was reported at up to approximately $1.7 billion, combining a stock sale, a credit facility, and consulting arrangements, and accounts of the total have varied. Whatever the precise number, the founder left with a fortune while the company went into emergency surgery. The surgery was severe. Thousands of employees lost their jobs. Acquired side businesses were sold or shut down. Expansion stopped. Leases were renegotiated or abandoned, and SoftBank wrote down its position by billions. The company that had spent a decade being described as inevitable spent the next year being described as a cautionary tale. WeWork did not die there. In 2021, it returned to the public markets through a SPAC merger at roughly $9 billion, about a fifth of the peak, and called it a fresh start. Then, hybrid work arrived and stayed. Office demand softened across nearly every market the company had bet on. In August 2023, WeWork warned of substantial doubt about its ability to continue as a going concern. On November 6, 2023, it filed for Chapter 11 bankruptcy protection, primarily in the United States and Canada. The stock was trading around 84 cents. Market capitalization was roughly $44.5 million. Reported figures put debt near $18.6 billion against assets around $15 billion. 4 years earlier, the same company had carried a mark of $47 billion. It emerged in 2024, restructured and far smaller, still operating buildings, still renting desks, no longer pretending to be anything else. So why did it fail with all that money, all that attention, all that belief? Because none of those things changed the underlying trade. WeWork committed to landlords for 10 and 15 years. Its members committed for a month. In a rising market, that mismatch reads as flexibility. In a falling one, it reads as a fixed obligation set against revenue that can walk out the door in 30 days. And no story about community changes the direction of the cash. Growth is not profitability. A valuation is a price someone agreed to pay, not a measurement of what a business is worth. Charisma raises money, governance protects it. And a narrative can carry a company for years, right up to the day it has to be written down, filed, and read by strangers. This is Business Aftermath, the rise, the fall, and what happened next.